There's obviously very much in the news right now, the dispute that's happening in Hudson Yards. How do you think it's ultimately going to be resolved? It seems like the parties still aren't at the table.
Right. Look, the reality is that right now I think both parties have gone to their corners to some extent. There's litigation going back and forth. There's obviously rank and file members who are very frustrated with the situation, as demonstrated by some of the things that you've seen in the media with very large rallies, 15,000, and they continue to grow.
And there's attacks in the press back and forth, both sides.
Attacks in the press back and forth. So let me say this. I've said this before, I'll say it again. For the record, the Building Trades Council and its affiliates are prepared at any time to go sit down and to have discussions, even if it's before negotiations, but have discussions, open and honest, mature discussions about how we could come to a resolution where you have, a very large developer in the city of New York and
one of the most active nationally as well.
One of the most active nationally, and you have the largest building trades council in the country at war. And like I said, in any dispute, ultimately the only way those disputes get resolved is to have discussion. I will say that when and if Related makes that determination, which I believe is in the best interests of all parties, we're prepared to sit down and have a conversation. Absent that, we will continue to stand up and advocate for what we believe is the right thing to do here and what's fair and equitable. And Related will continue to take whatever actions they deem appropriate during this time.
So Ken, a few years ago, your firm, Alchemy Properties, took on one of the most challenging things to do in New York, which is take a crown jewel, something with a lot of heritage, a lot of history, and try to sell condos in it. Tell us a little bit about that process and where you are now.
Well, you're right. The Woolworth building is the most difficult project we've done to date. A landmark building, gorgeous facade, and remember, we only own the upper portion, not the lower portion, so anything we had to do, we had to go vertical through space we did not own. And when we bought it, we had to put a whole team together of landmarks consultants, landmark architects, etc. So before we put anything in the building, it was a year and a half. I mean, gratefully, we've closed on our first units in the building. We have a TCO for probably 6 or 7 floors, and we anticipate having the building completed probably by December of this year, fully completed.
You're in a market which has faced some resistance, at least in velocity. Things have definitely slowed down when you're talking about luxury product of this kind. How have you navigated those challenges?
We have known from day one that for people to buy at Woolworth, the building would have to be more complete. And the velocity of people coming into the building now is extraordinary because you have vertical transportation, you have elevators in now. We didn't have elevators in until 5-6 months ago.
It was a chore just to take buyers up.
People were going up in a hoist, and that unto itself was a challenge. But now, with models done and units finished and TCOs and the lobby nearing completion, it's an entirely different ballgame.
You have a penthouse that's been talked about, the penthouse. You're saying every unit's a penthouse, but you have that $110 million penthouse, one of the most expensive downtown, if not the most expensive. What do you realistically hope to achieve with that penthouse?
Well, initially we designed it to be fully completed. We now know that people who are circling around want it to be their own vision. They want to put their own stamp on what the design is going to be. We couldn't get anyone in there for months. So the folks who expressed interest were really looking at floor plans. And remember, it's a 5-unit, five floors. So it's a very unique asset. It's almost like a castle in the sky. So this Thursday is really the first time that we are actually walking through the unit and will feel safe and secure that buyers can do that as well.
You haven't said anything about a price, but I'll let it go for now. Ken, good luck with the project. Thank you for being here. So Hall, your co-president Bess was on stage with us, so I figured I'd grab you for a minute.
Of her. She's just the best. Unbelievable.
She is the best. So
Best
tell us,
business decision I ever made.
when did you bring her on board?
5 years ago.
Okay. And now the firm is going through a transition of its own, right? This is a market that you were traditionally known as sort of the white glove brokerage. Now you're transitioning into all different product types. You're changing the look of the brand and sort of the sensibility. Talk a little bit about that.
Well, we've always dominated the high end of the market, which is what gives us that reputation. But also, we've always done the entire market. I mean, traditionally, a third of our deals are under $1 million in New York City, and no one really believes that, but they are.
That's not the image you project.
It's not the image, and that's because we dominate. We do more sales at the high end than anybody. But a third are under $1 million, a third are between 1 and 3, and a third are over that. And the market over 10 million, we do more than anybody else.
And I didn't get a chance to bring this up on stage, but in terms of agents, keeping a John Berger, for example, what do you offer them? They're probably getting offers left and right to join.
So many offers, and we're so lucky because we have so many high-producing great agents, and it's because we focus on selling real estate. I mean, what I do for brokers is help them be successful. Show properties with them, list properties with them, work side by side in making the deals happen, and that's why.
But someone says, hey, you've lost some. You lost Kyle, I believe, 3 years ago. But that doesn't happen very often to you. But typically someone's coming in and saying, hey, there's $1 million signing bonus. How do you contend with that? Because you're not offering a matching.
No, we can't, and we don't even try. I mean, we provide the best service, the best platform to be successful in this business, including manager support. And, if somebody, you just have to let them go. It's just the way it is. But we really do offer a great service to brokers. And if they want to focus on selling real estate, we're a good place to be.
Clelia, you run a traditional brokerage model at Warburg. Can you tell us a little bit about that? And you also work on the technology side. Can you tell us a little bit about how those two things square and what that's all going to mean going forward for the industry?
Yeah, absolutely. So I came into the industry in part at the request of my father, who runs Warburg Realty, which is one of New York's actually oldest real estate brokerage firms, who I think sensed that there was disruption happening. And my background was somewhat in kind of disruptive innovation. And when I came in, I really did see that things were changing, and this was 5 years ago. But we already saw the foundation of the evolution, the arrival of Street Easy, the change from being a guardian of information to being a professional services provider, and then all of the changes that went along with that, the need for the agent to have more of a brand platform, the need for there to be different kinds of services offered by the brokerage. And so we, at Warburg started to enact some of that, and I think our disruption has actually been more about our service model than it has been about technology, because there haven't been very good technologies for residential brokerages. But it is true that I do then also invest in disruptive companies as a venture capitalist. And I have investments in companies that are full disintermediators, and I'm working now with a company that's going to be more of a Redfin type hybrid model.
How do you see the traditional brokerage model changing going forward, given all of the new companies that are coming on the scene?
Yeah, so I tend to think that what's going to happen is almost a 3-layer model, and this is what we've already seen happen in wealth management, for instance. That you're going to have a platform that's fully disintermediated, which means that it's going to be primarily technology and almost no humans involved. And there's a company, for instance, Homey, which has this past year become on a transaction number basis the largest player in the Salt Lake City marketplace, and they're a full disintermediator. And then you see at the kind of mid-level, I call them discount providers or hybrid models, something like Redfin, and Redfin's extraordinary market share at this point. But I actually think that in what I tend to call high value, high volume, high complexity marketplaces, and Manhattan is the perfect example of this, you're always going to have the traditional brokerage model at the high end, but it's going to be a smaller world of traditional brokers, and it's going to, we're going to really need to be good at our jobs.
Diane, thank you so much for chatting with us. I've heard you say before that you don't just point an arrow to a new part of the country and decide to open an office. Can you tell us a little bit about what it means to you to grow organically and how you decide to move into a new market?
I think it's very important as a company to have a culture. And my feeling is, in creating your culture, you need to know what is the core the most important part of your company that attracts everyone to it. And for us, being a Manhattan firm is very important. So in our growth, which has mostly been organic, very strategic, and I believe smart, but organic, is we always look to spread out from our core market, Manhattan. So our first foray was into Brooklyn, and that was a perfect synergy. And now we have 9 offices in Brooklyn, and I always kid, we own Brooklyn. And then as we realized we wanted to spread our wings even further, we thought the suburban towns would make sense. Now, many of our sellers and buyers live in Florida and other areas, very, Aspen, wherever. But the connection to Manhattan is not as essential to them as it is to us growing organically right around the wheel. The spokes going out, but the core being Manhattan.
Your company recently did a really big, ambitious, and really elegant rebranding that took into account the different regions. One question that I have is, as agents develop it's more important for agents to have their own brands. How did you navigate that balance? Rebranding the company in a way that would let the agents have autonomy when they need it or want it, or I don't know if autonomy is the right word, but letting them spread their wings as well.
Right. Well, we do think the agents have to be able to own their own brand as well, knowing that the two combination is important. So in our rebranding, other than the fact that they're so excited as we are because it's so multidimensional, it really is the essence of who we are now. And then we allow them to put their branding in along with us. Ours, of course, has to be more important than theirs because we hold the license. But I think us also being creative with color has been very exciting for the agents. We're doing 3 color palettes for our regions. We have a Manhattan color palette, we have an outer borough, which is a little more vibrant and exciting. Manhattan is very elegant. And then our suburban markets and our waterfront properties have a more calming blues and green palettes. So the agents are really resonating with that. And even if they don't have their own personal brand, they are branding with the accent colors for their region, so giving them a sense of identity within our brand.
There's been this big shift from banks to non-bank lenders. What are some of the institutions that you're seeing in the market now that maybe weren't here a couple of years ago?
That's a very good question. I think there's been a huge void that's been filled since the last cycle by finance companies. And it really started as the economy recovered and we worked our way through the issues associated with the credit crisis. It started with the Starwoods and the Blackstones of the world who've since created mortgage REITs, but it's since gotten much, much, much more competitive. And I think what we've seen is more capital flows into the debt space than I've seen really since 2006. The spreads are compressing on floating rate and fixed rate loans, and I think it has to do primarily with competition. There's not enough deal flow to feed the financing machine.
So we've seen a hedge fund, the Children's Investment Fund, issue a $1.25 billion construction loan, I think, for HFC's Highline condo project. Would this have happened 5 years ago, that a random hedge fund from Britain would just come in and give more than $1 billion to a single project?
The answer is probably no. I think that capital was necessary and needed, particularly for construction loans, because your traditional commercial banking universe, who had sort of filled that niche for reputable developers in prior cycles, was gun shy at the beginning of the cycle. And so there were developers who could borrow on a non-recourse basis from single source providers, but they had to pay a little more for it. And they were willing to do that instead of going through the headaches of trying to find financing with a large bank syndicate with multiple parties. It takes time. They were generally fairly conservative, and so I think that sort of capital was necessary, and it's provided the marketplace in New York City specifically with liquidity and with a lot of new buildings.
You just did a big lease on the west side. You helped BlackRock move to Hudson Yards. You're also in charge of leasing at 3 Hudson Boulevard that's nearby. So we've always had people tell us in recent years that there's this big shift happening from Midtown to the West Side, sort of a gravitational shift in the office market. Is that really happening, or is it sort of just all marketing?
Well, I think the answer is yes and no. Yes, there's an unbelievable tilt towards the West and the South. The battle for talent is so acute, and companies feel like to attract and retain quality young people, they want to be in fresh, new space, and they love being on the West Side, closer to where many of these young people are living. But Midtown, JP Morgan Chase, some recent activity, the new zoning, the great transportation is still doing well and is actually continuing to do even better recently. So I think there's room for both markets to be successful.
A lot of people were really pessimistic about Hudson Yards and Manhattan West. The argument was basically you're going to charge Midtown type rents in an area of the city that's basically New Jersey, right? And there's only one subway train that goes there, and it's sort of far away. What did the pessimists get wrong?
Well, they got it really wrong, right? I mean, you could just see by all the tenants that are choosing to go there, it's going to be hugely successful. Yes, we have not seen it all up and running, how the 7 train is going to handle all that. But I think the new New Yorker doesn't mind walking a few more blocks, doesn't mind riding a bike to work, finds their way, and I think it's a different paradigm than maybe in the past, and I just think it's going to be an amazing place.
Mm-hmm. And by extension, does this mean that the traditional Midtown office market, Midtown East around Grand Central, is that losing some of its luster? Do landlords in that area have to do more now to compete with the West Side?
I think landlords there are already saying, yes, we need to compete, we need to put in new lobbies, we need to upgrade our systems and make them better, the elevators, destination dispatch so there's less waiting time. We need to energize our buildings with amenities and services. And that's already happening. And the new zoning law might allow some landlords to put new facades on to stretch the size of the buildings. So again, I think there's going to be a healthy competition between both.
Mm-hmm. So the big story in New York City leasing over the past 5 years are the so-called TAMI tenants, right? Yes. Tech companies, media companies were reportedly the driving engine behind the leasing boom in recent years. Looking forward 5 years, who's going to be the leasing engine over the next 5 years? Is it still going to be TAMI or is it someone else?
Well, I'm hopeful that the tech companies continue to say New York is a great alternative to the Silicon Valley. We're seeing that now with Facebook and the Googles and Spotify and Amazon with tremendous commitment to New York. If that can continue, that's going to be really good for New York City. The financial service tenants are still a huge factor in this market, and I think they're starting to feel better about things in New York and will continue to grow. Law firms, media. So we're fortunate, we're really blessed to have a diversity of tenants. When the tech market corrects, it'll be a problem for New York City. But when the tech market corrects, it's going to be a real problem for the Silicon Valley. So I think we're fortunate that we have a diversity of tenants here.
So basically, if a bunch of tech companies go out of business, you still have some banks who can take
and other
this
companies
space.
here, exactly right.